Hey everybody, back with another ETF review, and today we're going to be looking at the Nationwide Risk Managed Income ETF, or NUSI. We'll be looking at this ETF because I get a ton of questions about it, people asking me why I like it, what it is, how it works, so I thought we would go over that today. As usual, we will start with the expense ratio, and as we can see here, it sits at a 0.68%. That is relatively high as far as expense ratios go. This is not one of your ultra low cost funds. This is actively managed, so it is going to be higher. So just keep that in mind. For every $10,000 you have in this fund, they are going to charge you $68. That's not a ton, but it's also not nothing, so just be aware. Next, let's take a look at the yield, and currently we're sitting at about 7.8%. Very nice if you are an income-focused investor. This is much better than any dividend appreciation fund, any high dividend yield fund, any bond fund out there that you're going to find. This is a covered call ETF, so you're going to get that rather high yield. So what exactly is it when it comes to covered call ETFs? There are a bunch of them out there. What does this one do? Like all covered call ETFs, it's going to buy underlying securities or an index, and then it's going to sell covered calls on that index or securities. What makes this one different and why its yield is a bit lower is that it uses an options collar strategy. What does that mean? It sells the covered calls, as all covered call ETFs do, but it also buys a protective put on all of those positions. What does that mean? That means that in the event of those positions going down, dropping by a particularly large amount, there is a cap on how far the investment can go down, because that will trigger the protective puts to exercise and you won't be losing as much. Now, what that's going to do is lower that yield a bit. Whereas you have a lot of these covered call ETFs that sit between 8 and 12%, usually around 10%, right in the very high single or very low double digits. This sits right between 7.5% and 8%. That's because some of those premiums from the covered calls, instead of paying them out to you, they use those premiums to buy the protective put. They are using the premiums from the calls to create that downside risk protection. So keep that in mind. This isn't going to yield as much as your other covered call ETFs, but it is going to have downside protection in theory. Next, let's take a look at those distributions to see what they're like, and if we go to their fact sheet, we can see that over the last 12 months, the distributions have been about 18 cents. They even actually do the math out for you and show that you're getting about a 0.65% distribution per month, because this is a monthly distribution. So if income is very important to you, particularly to spend, a monthly distribution is pretty nice. Next, let's take a look at the performance and see how it's doing. Actually, before that, let's take a look at the portfolio, which we can see here. So this does write covered calls on the NASDAQ 100, which means any company that makes up that index is going to be bought by this fund. We can see here that the top 10 holdings go from Apple to Adobe. It is very, very heavily weighted at the top, with Apple at 11%, Microsoft at 9%, Amazon at 8%, then it starts to trickle down. The reason for that is most likely, I'm not 100% sure because I haven't done the most research, but that they have the most options volume, so you're going to be able to get good premium prices there. Going to be able to make that money, make that distribution yield. Next, we can go look at the portfolio. At the portfolio performance, and I've got a couple back tests run. First, we'll start with it against others of its peers. We can see that Portfolio 1 has NUSI. Portfolio 2 and 3 are made up of the Q yield and Y yield from Global X. The NASDAQ one is essentially the same fund as NUSI, but without the protective puts, whereas XYLD is the same thing as QYLD, but on the S&P 500. And as we can see here, NUSI has performed better. Even though it has a lower yield, it has performed better over the trailing roughly year and a half. We can see that we're currently sitting at about a 28% increase over that time, while the others sit at about 10 and 11, about 11% each. What is particularly good about this fund, which you can see here, is that the drawdown is very, very slight compared to its peers. So that downside protection that it says it has did work in the 2020 crash. Granted, that's only a very short-term history to look at, but we could see that their worst drawdown was 8%, whereas its peers did 17 and 24.5%. So if you are looking for that drawdown protection, if you are looking for that downside protection, so far so good. Unfortunately, we only have about a year and a half of data, so we can't know for sure, but so far so good. Next, we'll test it out against the wide markets and against a similar ETF strategy that some people use in terms of income. We will have NUSI again in our first portfolio. In our second portfolio, we will go with the S&P 500, and in portfolio 3, we will use a dividend appreciation ETF in the form of SCHD. And as we can see here, it is trailing those two, though not by that much. We can see that over the time period of about a year and a half, NUSI has only done about 28%, while the other two have done about 39%. Definitely worse, but not as much of a difference as we saw in our other performance test. Again, we can see here that its drawdowns were very slight compared to the others. Here, the 2020 drawdown much less than the S&P or dividend appreciation ETF. We again see that happening in September of 2020, and then we can see that when the market started to fully recover, it did start to lag the broad markets, but that is to be expected because it is downside protection. It is going to limit some of its growth to protect you from that downside risk. So overall, it is doing well against its peers and doing worse, but not terrible compared to the wide market. So, should you be looking at this ETF? Is it something that should be in your portfolio? It really depends. If you are an income-focused investor, I think this is the best covered call ETF out there. Overall, it doesn't have the yield of others, but that downside protection. If you're worried about an overpriced market, this could be something for you. The one thing to remember is that downside protection is only for large, quick drops. We're talking about something like what happened in 2020, where if the market falls, say, 50 or 40%, NUSI might only fall, 15, 20, 25% because of those protective puts. However, in a long, drawn-out bear market, this is going to underperform just because of the strategy. Using those premiums to buy the protective puts, which aren't going to trigger, is just going to be losing you a bit of money, which is just going to go down with the security prices as well. So just be aware of that. If you are looking at downside protection, this is for quick downside protection. This is for crashes. This is for corrections, things like that. Long-term bear markets, this isn't really going to protect you. It's going to do probably what its index does, and then with the slight losses from the protective puts. Dividend appreciation wise, there's nothing here really. This is an income focused thing. You're not going to be getting the yield to go up. They have said that their targeted yield is 7 to 8%. So regardless of what the price of the fund is, you're going to be looking at a 7 to 8% yield. So this is definitely on the income focused side. So if you are an income investor, this is definitely something to look at. If you are particularly scared of the market right now, this is definitely something to look at. If you're both, this might be the perfect thing for you. Just keep all of what we've said in mind and make sure it's a good choice for you. I hope that helps, and thanks for watching.